Hey everyone, it's Pete Carmasino here at Chaikin Analytics. This is the halftime show here on Stock Charts TV. Today's Tuesday, August 29th, and we're just going to be talking about, obviously, what everybody else is talking about, the Fed and Jackson Hole and what happened last week and what's happening today, which is not a lot of concern with the Fed talking, or should I say jawboning, higher rates from last week. And so there is one thing I would like to point out that the Fed mentioned, and I say the Fed, I mean Jerome Powell, who is chair of the Fed. We were talking about the labor market. I'm going to bring that chart up again, okay? It's important that some people are misreading this chart that I keep posting on Twitter. By the way, follow me on Twitter as well. And it's not about waiting for unemployment or predicting or whatever the case may be. It's just it's a cause and effect situation. And Powell said it, I mean, word for word in his remarks, that if the labor market remains very tight, there will be an adjustment to a monetary policy response. And I'm paraphrasing a little bit, but you can look it up, and I'll pull it up. We'll look at it here on the video as well. And what that means is things are still very strong in the unemployment, meaning that there is a very low unemployment number. If that weakens or increases, in other words, more people become unemployed. It gets a little confusing when you're talking about unemployment versus employment. And so when the unemployment rate is low, everyone's working, obviously. And so when that increases, we're probably going to see a response. Now, everybody's been talking about this, but it's not something that isn't known, right? Go back and look at the chart since 1960. I think it even goes back to the 50s as well. That's what happens. And so we're going to talk about what the actions might be when that happens. So when the Fed is starting to talk rates down or even actually cut them at this point, we know that fixed income, bonds in general, bond proxies, high dividend paying situations, whatever the case may be, stocks and or fixed income, will positively react to that. Okay. And so that's when there could be a positive move, not only in the stock market, but definitely in the fixed income market as well. As rates come down, bond prices will soar because, and I say soar, depending upon where they're coming from at that point, right? So a 10% move in the bonds is pretty significant. I mean, it's not something that moves like that typically, but we've seen even larger declines on the downside than 10 and maybe even 20 and sometimes 30% off the top of, say, a symbol like TLT. So we'll talk about some charts today. I'm also going to look at stocks that are changing trend that I ran the screen today. I'm going to give away those names just so you can take a look at them, kind of get an idea of what we're talking about. It's going to be a shorter version today of the halftime show, but I appreciate you tuning in. We are preparing here. I'm in the Tampa area. We're preparing for a hurricane, and thankfully it's moved a little bit north, but we're thinking of all of our fellow residents here in Florida north of us and hope that everyone fares well. So with that, let's jump into these charts and talk some stocks. All right, now I'm pulling up a Reuters article here, and it's just talking about the highlights of Fed Chair Powell's Jackson Hole speech. And what's highlighted down here is the rebalancing of the labor market that Powell talked about. And again, it's continued. Now, look, it remains incomplete because there are plenty of people still working. Now, there is some data in the BLS, Bureau of Labor Statistics, that is let's just say, I don't want to say sketchy or intentional, whatever the case may be, but there's less respondents to the survey, which means it may not be as accurate as it used to be. But like, you can't ignore the headlines. You're seeing people lay off all over the place, whether Charles Schwab just made that announcement last week, but there were several others as well. And you're continuing to see it. When you see revenues at places like Best Buy or anywhere, retailers, whatever the case may be, when the top line slows, right, the bottom line has to be addressed immediately, okay? And so that's unfortunate in some cases because it's going to mean some folks may be laid off or be transitioning into other types of work. But that's what this is talking about. When it remains incomplete, right, he's using very soft language here, and that expect this labor market rebalancing to continue, which means that people are being adjusted, whatever the case may be. That's what this means. And the evidence of the tightness in the labor market, meaning that the unemployment rate being low, is no longer easing, and could also call for monetary policy response. All right. And the chart I'm referring to is just looking at the unemployment rate over the Fed funds effective rate. Every time the unemployment rate has ticked higher, the Fed funds rate has come down. And when that happens, you're going to see fixed income and any kind of high dividend paying securities react positively. It could be a positive for stocks in general, but don't forget, there is a negative to higher unemployment. That means we're slowing and potentially, and most likely, heading into a recession, which doesn't mean the end of the world, but it does mean that it is a slowdown and that things are being adjusted, for lack of a better word. Again, a friendlier word there, meaning that when this starts to happen, be prepared to see stocks and bonds potentially in the beginning of this cycle move in opposite directions. Not a guarantee, but it seems to happen all the time. And look in the past, and we can look at some charts on the fixed income side as well. Just a reminder, look, I'm on Twitter. You could follow me on Twitter. It's at Pete Carmasino. I put out some interesting charts here. I think they're interesting. We talked about this NASDAQ chart here last week, and I just did a little bit more creative design here, adding the gap fill and DD means drawdown of about 14.5%. If that was to happen, doesn't look like it's likely or anytime soon, but it is in the cards if things start to break down. And this was the layoff I was talking about. Look, Schwab's the latest to mention it. You're talking about tech layoffs. They are not immune to this. And so there's that push and pull, right? When rates come down, we know that tech stocks like lower rates. However, if the consumer is struggling and they are buying less, it's going to negatively affect the tech stocks and tech market in general. So it's not at all clear there. I would think when and if, I should say, when the Fed funds starts to pull back a little bit, if they start to cut rates, fixed income is the play at that point. And that's not necessarily a risk off play. It's just a different asset class is going to perform in that specific environment. So pay attention to that specific language. I'm pulling up the S&P 500 here, and I added this gap fill in here. Now this drawdown would be about 13.5%, and I use the word ish here because it's not exact here. I don't know exactly where it's going to fill or potentially fill this gap, but it is a gap. There's another one up here too. It's tiny, but it's probably going to get filled and go to this one if this even goes that low. What we're seeing is some interesting moving averages that are starting to come into play, which are the 70 and the 35, and they're kind of sitting along these trends. You're seeing that happen. Last time the 70 hit here, when these two crossed, they started to move higher. Again, it's anecdotal currently, but if we continue to see this type of trend, we may start to use these. But there's that 200-day. Look at this. It's firmly along the channel. I don't know if it's going to test. I wish I knew for sure. My point is that it's there, and you have to respect it until we get into areas of higher ground, and we're not there yet. So that's really the S&P look, just in a nutshell. I can't ignore the dollar chart here either. Let's dig into this just really quick. Again, it's sort of an unorthodox chart here. I got a downtrend that was firm beginning really at the beginning of March or so, but it was obviously in a massive downtrend here. And that's because rates had just reacted so aggressively as well. And what I mean by that is that when rates are moving higher, the dollar is typically going to react and go along with rates. And so that's opposite of fixed income. And then when the talk was lower rates, obviously this started to happen here as well. So you can see what's happening. Now, this shorter term trend is just a pretty decent breakout. Not quite to a new high, though. I would say that's shy. I don't have the current, this is the end of day quote from yesterday. I don't have the current dollar quote. I apologize for that. But as of the close, we saw sort of a turnaround a little bit here, and it's starting to move, sort of backfill a little bit, maybe back to that moving average. But I can't ignore the 50 simple moving average here curling higher and getting toward that 200-day. So we might see sort of a meeting of the minds here between the 200 and the 50-day, somewhere around this 103 to 102 level, and then continue higher. But you cannot ignore the dollar move here. I'll post this chart here on crude oil just because it's been an interesting trade. You can see where the White House announced they were going to start refilling the Strategic Petroleum Reserve. That's down here around the 67.72. It became a range. It became support, and it's certainly been tested several times and held. And now recently we've seen just some movement over there in the oil market. When I say over there, I mean in OPEC and some other areas where there might be some restrictions that are lifted, and people are playing with the supply. When you play with the supply, you play with the price. And when the price is being played with, things are being affected in the economy. So it's something you got to watch. It's obviously sort of a trigger for other events. But again, still solidly above 75 and really just teetering around this $80 price as support. Energy, another sector that I've been focusing on, obviously, because we just talked about oil. I'll look at the XLE. Definitely in an uptrend here. I like it. The ratio chart's struggling a little bit, but sometimes you're seeing the ETF, the sector itself, really be ahead of the ratio. I should say almost all the time, but sometimes they're in pretty heavily synced up like they were here back in 2021. And then obviously the trend just blew out of the water. I mean, this was like the best performing sector in a very long time, where energy's been up there in the top number one spot. It's not been, it's been a while since they've been in that position, but there it is. I mean, that's kind of what's happening with energy. I do like it. I think it's a focus, and maybe we're going to see some of those names in some of the stocks we're going to talk about in just a second. Okay, I stuck my neck out on this. My target is not out of the water yet, or out of the question, I should say. 75 to 80, I think, is the target. I think that's going to be coming from just testing these higher levels here back in 08. And we know what was going on back then. I'm not suggesting another global financial crisis, not in the least, but I am suggesting higher rates. And I think the 10-year is trending higher. So is the 2-year. And there's your unemployment rate. Now, I talked about this because if we start to see rates fall, right? Look at the 2-year back here, right? In 07, we started to see the 2-year come in a little bit. We started to see the 10-year come in a little bit. And what do we see here? We start to see unemployment tick up. So any kind of inkling of this will start the rate crisis. When I say crisis, I mean sort of the rate trend change on the downside, which will affect fixed income, just like it did here for the TLT where it peaked. Then when the economy slows a little bit and you get into recession, things just go sideways. That's all. Okay. So you got to be careful. But I do think the positive reaction from fixed income will come if we see rate cuts. Again, if we start to see that. And as I said, a lot of folks are calling for that to happen in 2024. And I'll look at the TLT here on the Chaikin system as well, just to get an idea of what we're seeing. Obviously, negative relative strength. We are in a bearish trend. You can see that. You can see the long-term trend absolutely pointing lower. So it is a weak trend, although it's bumping up against that number today, up about 1%. Look, things are positive today, and that's kind of what we want to see. We do want to see bonds moving in the same direction as stocks. It's nice, it's comfortable, it's cozy, but at the same time, you cannot ignore this is still in a downtrend. Just be careful. So here are some names that I saw on my screener today that are changing trend. So some big names here like Splunk, which is obviously in the software business. We know them to be sort of in the cloud services and so forth. Breaking out. Now, this is something that you don't want to chase here, but I can't say where this is going to stop because Splunk has a pretty good upside to it. If you look at the 5-year chart, I mean, it's been up to in the $200 range, so that would be about 100 and some odd points above where it is right now. The trend has been choppy at best. Look at the chart. Look at our relative strength, although we do have very strong fundamentals. So it's just an interesting name after blowing out numbers just last week on the 23rd. Another one is Williams-Sonoma, specialty retail. Who knew? Retail was still alive here. I would say that this is really bumping up against this area of resistance right around that 146 level. And look what it did. It came back here and tested right around that support level of about 140 or so. I think if it can rally above here, this could be a name that starts to get above its 52-week high of 155. And if I look at 5 years and just look back, maybe we can see this start to move even higher, right? Even up to this level of the $200 point. Again, it's a long road from there, but it is trending in the right direction. Pretty interesting setup, I would think. Another one that's interesting here that pulled back hard and now has found support and rallying a little bit is the Trade Desk. They reported good numbers here. They beat estimates by just a few pennies, but the relative strength kind of slowed down here with negative money flow. Just one to watch, but I still see the trend really starting to push up a little bit higher. And it looks kind of interesting here. Just look at some of the names here in the list. I can't go through everyone. I wish I could. Just don't have enough time to do that. But here are some names you can consider just take a look at them. Some are in the retail space, so just be careful. I know Guess had great numbers here. I mean, they really had good numbers, 72 cents versus 40. The stock up another 5% today. And again, look what's happening. We're really testing some 52-week highs here and trying to break them. It looks like Guess actually just did that. The recent high in the last 5 years is somewhere around 31. That's about 6-7 points from where it is right now. Decent amount of upside, but just, again, something to be careful with. Again, specialty retail, not out of the woods considering where the consumer might be headed with a lot of high debt and things that are changing here in the next few months. Okay, everybody, that's all we have here for the halftime show. It's a little shorter version. I apologize. We are kind of hunkering down, as they say, a little bit. Again, hopefully won't be hit as bad as expected. And again, our thoughts and prayers go out to all of those that are affected there in the northern part of Florida, here on the Gulf Coast, and then obviously across the land, heading all the way to the East Coast. If this hurricane can keep up those speeds, hopefully it's just less damage than anyone expects. So our thoughts and prayers are out to everybody. Follow me on Twitter, please, at Pete Carmasino. I'll put out some more interesting notes. Give me some feedback here as well on this video. A like would be great. And give me some feedback. Give me some commentary. I'll respond as quickly and as best I can. Take care, everybody. We'll see you next week.